Sorry, I wasn't recording that. But as we were saying, right, what ends up happening is a lot of times people will get confused as to why a market is ranging. In all simplicity, it's simply because it's either redistributing or reaccumulating, right? So think of term in terms of cause and effect. Why are you thinking in terms of cause and effect? Because this specific accumulation right here at the bottom is a cause of this effect, right? Of this markup. Now, the reason because of this is simply because institutions want better entries. Right now, if you would look at this on a higher time frame, you would end up seeing that this is the pivot point for a buy, right? Now, this is the effect, right? This huge buy is the effect. Now, how would you have caught that with Wyckoff schematics? You would have caught this simply because you knew the blueprint of the market and you knew what to look for. Price action is much simpler than you actually think, right? So right here, you see a previous zone, right? In terms of supply and demand, you would have thought this a demand zone, correct? Now, because you would have thought this a demand zone, you would have said, hey, I want this demand zone to grant me, a certain entry, which would have been fine, right? You would have been given that entry. Now, where does that entry actually come from? Well, it comes from the fact that this point right here actually is, the selling climax is down here, but you also have a test right around this area, right? So this supply and demand area is letting you obtain this entry on the spring and on the test, right? So those are the what is a spring and what is a test? The only thing that a spring is really when the market touches the bottom of a zone and kind of establishes it. So, it's the part where it bounces off a certain zone. That's what a spring is technically called. Now, this test is really when it comes back down to around the same area. And if you would fib it, it would be around your 705, right? And you would enter off of that position, and then you would have held the swing buy, right? Minimum drawdown, almost no drawdown. The reason for that is simply because you knew the blueprint to the market. And this happens everywhere. This doesn't only happen on stocks, right? And I'll show you guys a markup for USD Cad, and I'll show you guys how I looked at it there in a second. So again, we see accumulation. We see this giant push up. But before we see that giant push up, what do we see? We see a demand zone establish itself. We see a break of the downtrend, right? And we see it kind of consolidating or ranging as retail traders know it. Again, right? I'm just restating this so for the record, and so that you guys know and understand how this market moves, right? The phases. So we come to hit the spring, we come to hit this previous zone, right? Fill this liquidity void, boom, right? And then it booms back up. Now, what do you think it made that move back down? To shake off, weak buyers, to make sellers kind of jump a little bit in joy because their entry was all the way down here. They're like, oh, we could probably come back into profit like tomorrow or something like that. New day starts, you start up higher, right? And you already know that if you entered right here at the at the end of the day, at the end of the trading day, you know that your entry was valid, right? That was a beautiful entry on the test. The test is simply a retest, right? That's all it is. After the spring actually happens. So this is a kind of a zone where you're like, I need to enter like now, right? And then it shoots up. Now, what happens when it shoots up? This fib, right? These fib settings end up giving you the extensions, right? Fib extensions, which would be your last take profit right up here. And your last take profit ends up getting hit about, so April 28th, April 3rd. So a little bit less than a month after you made that investment. But if you would have gotten in on the test, right, and you would have, hit your take profit a couple of days later, even at a low lot size, you would be up a lot of money, right? And if you would have continued holding that, you would have gotten an even bigger investment position, right? So that's kind of how the market moves, right? That's how the market fakes people out, because a lot of times people will end up not looking for enough confirmation, and they will end up falling for these institutional tricks. And that's really all it is. A lot of people will say, oh, use this indicator, use that indicator, or only use fibs, or only use supply and demand zones, only use breaks of horizontal levels. But the problem with all of these strategies is that they don't take in mind the fact that there has to be accumulation of money and distribution of it. So you could be correct, right? You could be correct in saying, hey, the market is, breaking and retesting these order blocks, or, horizontal levels, whatever you want to call them, which you would be correct. But at the same time, your mentality isn't correct. Your thoughts and processes of the market isn't correct, which is why you need a little bit more of, a little bit more thought into it before you say, hey, the market's just doing this or just doing that. The market just isn't doing anything. It's doing what it's meant to be done. So we're given this example. Does anybody have any questions?
No.
Nobody has any questions? No? Okay. So it's the same exact thing happens right here, right? This demand zone is established. Beautiful entry on the wick, right? Or you could have put it a little bit higher as well. Beautiful, right? And then you would have also put your fib right here, because it is a different, it is a previous impulse. So what ends up happening, you get your 705 hit, right? Minimum drawdown. And since you get your 705 hit, what happens? You have this previous low, right? You get your spring, you get your test. Well, sorry, you get your spring, you get your test, and then you get a buy. So either way, you could have entered right here, which is still valid, right? Or you could have entered right here at your 705, right? Perfect. Either way, you get an entry on the spring or you get an entry on the test. Whichever way, you get your effect, your cause, right? Your cause, which is your accumulation, and then your effect, where you get, your buy. Now, what do we see here? Your market climax. This is where the market climax could possibly be, right? It's at 1,200, right? 1,200 is a pretty high price for a stock. Usually at the even numbers is where stocks struggle. Stocks and pairs alike struggle at usually even numbers, right? Or with zero zeros. So what happens is this could definitely be a market climax. If this becomes a market climax, what is going to happen afterward? If we look at our Wyckoff schematic, buying climax, distribution, failed rally, test, sell, right? So what do we see right here? What could this be the beginning of? This could be the beginning of our next possible cause, right? So think of it in cause and effect. So next possible cause. Right? Possible cause? Question mark, right? And that's how you want to think of it. If it ends up, making, different moves, and it actually establishes its range, or its TR, or also known as trading range, right? What's going to end up happening is it's going to start, bouncing along its spring. And then from there, what are we going to be looking for? A failed rally that matches up with its buying climax. So if this is truly the buying climax, then we could possibly see something like this. We could definitely see something like that, then another entry like this, right? And then a spring close to its buying climax, and then a boom, right? A test, and then a straight drop like that back to accumulation. Well, I think I drew that a little bit too far, but realistically, let's say it falls to down here, right? Back to around this area. And now what would you do? Now this is where you would start looking for accumulation again. Market climax, boom, test, buy. That makes sense?
Yeah.
This is a lot easier when when you actually get to practicing it. It may seem a little bit complicated at the beginning, but it really isn't. It's really something quite simple, and it's something that you guys will fall in love with very quickly. It's a concept that has changed the way a lot of people trade, and it's something that you will end up looking at the market before it actually happens. So here, in this case, I'm going to be looking for a possible sell on Tesla, right? But it's going to be very short. I'm just going to be looking for, market climb, because at that point we are trading against the trend. We only want to trade with the trend. But, we can milk the market with this. And because of that, I want to make sure that, you guys are understanding this correctly. So next pair that we're going to look at as an example is going to be USD Cad. And I will show you guys essentially how I looked at this, and I said, next possible few days, we could have a very good swing buy. Now, I used to very much religiously say, hey, every single time we look at a USD pair, look at the DXY. The DXY can be very confusing. Now, it is very useful, right? Don't get me wrong. But it is also something that ends up being kind of misleading. So the reason for that is because the DXY is affected by a whole lot of things. So institutionally, can you trade the dollar? Yes. Should you? Right? Not really. You can, right? And that's a pretty big deal. You can, but it's I would advise against it, simply because of the fact that you're risking a lot, basically. So first things first, here we see that in USD Cad, always start your top down analysis with the 1 day or with the 12 hour, right? So you see it on the daily. What do you see? On the daily, essentially you see an uptrend, right? Essentially you see an uptrend. But let's, if we're not sure, we go up a little bit higher. What do we see on the weekly? On the weekly, we do see an uptrend, right? Some people might say like, oh, it failed to reach these highs, but you would end up seeing that these are what? Buying climaxes, right? So what would you expect? Accumulation for another buy, right? Easy. You know that because you have seen these schematics before. Now, what do you see here in terms of trading range? What is this? What is this line and this line? Let me change the color so that you guys can see it a little bit clearer. What is this known as? What is this known as? You guys should know this. Come on, guys. Don't leave me like that. You guys should know this. Trading range, right? This is the trading range. Why is this the trading range? This is the trading range essentially because the market is kind of stuck here, right? A lot of people would say, oh, it's consolidating, right? Now, the importance of the 12-hour time frame is simply because the 12-hour essentially kind of lets you know where the market is accumulating, or where it's distributing, where its cause and effect is. It's very useful. Now, do a lot of people use it? Not many, but it is very useful for you guys. So another time frame that's very good is a 2-hour, right? But let's stick to our bigger time frames right now. So let's look at our phases. We have our phase A, right, which is the selling climax. So we have our selling climax right here. So pay attention to this level. Selling climax. Selling climax right there. Beautiful. And we have our selling climax right there. Boom, right? Now what happens? What can we assume about this? It starts buying and then it starts selling. What do you think retail traders are thinking at this moment? What do you guys think retail traders are thinking at this moment? Nobody knows?
What was the question, bro?
So the question is, if it starts buying like this and then it starts selling off, what do you guys think retail traders are thinking about this pair?
Probably looking for a sell, I would believe, because of the large candle right here.
Right, right. So a lot of people will look for a sell. Are they wrong? No. But are they long-termly correct? No, they're not. Right? They're not correct because of the fact that, where is your market essentially going? Your market's going your market's essentially going to the top, right? So we have this sign of accumulation again, right? So is this passed as an accumulation zone? You could definitely, regard it as one. Now, where would the buy essentially come back to? So there are two places where the buy could essentially come back to. It could come back to the 886 back down here, right, from this wick, or it essentially could come up from this wick right here, right, and come back up. You do have a zone right there. Because of that, you can definitely look for entry right here, or you could look for entry down here, depending on the 2-hour time frame rejection, right? Do I think it's gonna accumulate right there? I don't think we've gotten a spring yet. So I think what might end up happening is it might come back down here and spring, and then come back up again, and then actually start jumping from there. Now that is a large, this is a large position that we're looking at. It's a large trading range of about 360 pips. Which do I think it could come back up? Yeah. But I would be looking at 2-hour rejection for this. So we could look for an entry right around here after it comes back to clear these lows, right, which would be the market liquidity. And then from there, it could definitely start buying back up. Why? Phase A says the selling climax. Right now, phase B, we have this trading range established, right? So just think of it like a checklist. Phase A, you find your selling climax. Phase B, you're waiting for your institutionally sponsored candle close to the selling climax or after a spring. What is a spring? Again, simply a place of rejection, right? Simply where you see it, where you see an actual bounce start happening. Now, you can also get it on the test, meaning you could say, oh, hey, this is an uptrend, quote unquote, right? And you start saying, you start drawing your retail trend lines and you start saying, oh, this trend is going up. Essentially, no, right? But you want to wait for that rejection to actually happen, and then you can get in on this on the test. For me, I'm waiting for entry at the 886 simply because that is the bottom of the trading range and because you have your selling climax right there. Now, because you have your selling climax right there, you are saying, hey, this selling climax is going to be my friend because I want it to clear this liquid low. Now, when it clears that, what do you want to wait for? A sign of strength, right? Meaning you actually want to see a rejection there. If you don't want to get in for a buy if you don't see a rejection. That's just dumb, right? Now you see your 886, you see a spring that allows a massive move up. You enter on the 886, you have your stop loss between the 1 and the 1.1, and then you shoot all the way up. Now, this is 87 pips for 757 pips. This is massive, right? This is why you need to be patient, because it still has to fall 188 pips. Could that be a swing sell? Yes. Is it dangerous? Yes. Right? It's very dangerous to actually do this, to actually get in for this sell, right? If you want to get in for the sell, then you're dealing with a couple things. You're dealing with the fact that there's a block right here, right? And then you're dealing with the fact that there's a selling climax down here that's probably going to, continue down and then bounce off of it. There's just too many bullish indicators for me to actually get into a sell. Will I get into a sell? I may very stupidly get into one for some extra pips. Is that good? Is that good management? No, but it is something that you can definitely do, right? It is something that you can definitely look at and be like, oh, hey, I'm gonna do it just to get a couple extra pips, which is fine. But that's only if if your trading plan can actually accept it. So if it actually does break this low, then I'll probably be looking for a sell to down here and then a buy from all the way up there. But I would be very careful with it, right? I would be very, very careful with it. So do you guys understand how my analysis for USD Cad actually lines up with Wyckoff schematics? Does anybody have a question or not understand? No? Cool, sounds good. So the next thing that we're going to be looking at is saying, if we look at a beginner, right, and we say, what is the first thing you want to learn? The first thing that you want to learn so that you don't get mixed up with everything else in the middle is your schematics. And it may sound a little bit weird to learn, but you want to memorize these so that you at the end of the day can look at it and say what phase is in, right? You should be thinking in terms of cause and effect. Now, what is cause and effect? Saying that if price is accumulating at a certain zone, right, like this, you know that this is compressing the spring. This is creating pressure in the market, right? For what? This is preparing the market for a big, if it's at the bottom, a big buy. If it's at the top, a big sell, right? Why do you do this? You simply do this because you want to think in terms of, hey, the market is doing this because it is preparing for another thing, right? You don't want to think in terms of trend lines. You don't want to think in terms of candle, one big candlestick to the bottom means sell. No. And I'll explain to you why that doesn't exactly mean that, because how many times have you seen a pair or an indice end up doing this, and then not the next candle it does that? How many times has this happened? Way too many to count, right? Way too many to count. And the reason for that is because a lot of retail traders only base their analysis off of one thing. They base their analysis off of, one candlestick or one fib level or, one trend line, and then they leave it there. You want to get out of that retail mindset, and you want to have one thought. If you're going to learn one thing from this Zoom, you should learn what the phases of the market are. And the phases of the market are fairly easy. The phases of the market will end up being, there's a sell right into accumulation. This is the climax, right? Now, what is the climax? The climax is simply where, the lowest or the highest point. So this would be sell climax, right? This is the selling climax, right? This is where the bearish pressure actually ends. Now, this is where you also will see rejection, and then you will see the start of a trading range. This right here becomes your TR or trading range. TR or trading range, right? And then from there, you will end up seeing a spring. And this spring, the only thing that a spring is really where you see rejection, right? And then you will see a test. Test, right? And then from here, this is where you would enter. Stop loss either at the selling climax or at, the bottom of the spring. You could have either one, doesn't really matter. And then from there, your entry would be right here, and then your take profit will be, if you use your fibs, right? If you would use your fibs at your fib extension, or you could put it at, a previous zone or a higher zone, right? So like say if like the low was right here and you're in an uptrend, sorry, if you see the high, you're in an uptrend, so then you can possibly put your take profit up here, or you can just leave it open, right? You can just leave it open and wait for an investing position to actually pop up, right? And that could definitely be something that you end up doing, right? Now you see this test, and then you see the effect. The effect is simply that is the effect, right? That is the effect. In terms of cause and effect, this simply means that the spring, or the compression, the accumulation that happens right here, and accumulation's right here, right? Accumulation. The accumulation that happens right here caused the market buy off, right? Like that. One, it shakes off, think like a bank. It shakes off people who are weak buyers, meaning, when they see that, they're like, oh man, I don't want to hold this position any longer. I'm going to take a small loss, right? So the banks get more money. Now you see a lot of people start saying like, oh, I want to sell, right? And then they sell right here once it breaks their quote unquote support, right? And then what happens? Oh man, it started buying, something like that. Thank God they got out, but they just weren't going in the right direction anyway. Why? Because they were too zoomed in. Say they're on the 4-hour, and they say, oh man, it's a downtrend, so it's probably going to continue, and then retest that and continue down. That's when people don't know what they're talking about, right? A lot of people try to use order blocks like that and say it's going to be a drop-based drop, right? If you guys don't know what a drop-based drop is, it's simply a pattern, an institutional pattern that is characterized, and it's usually on lower time frames, but it's characterized by a drop, then a little bit of accumulation, and then another drop, right? And then this becomes a zone where it will eventually retest. And then once it hits this, you'll see doji rejection, or you'll use Heiken-Ashi rejection, and then you'll see another drop, right? That's a drop-based drop. And it's the same thing for other things like a rally-based rally, which is the same exact thing, just going the other way, right? It would be, like a rally and then accumulation and then a rally. Now this becomes a zone, and then eventually it'll retest that zone. You buy from here, and then boom, right? Good. I have another video saying how to catch your entries with supply and demand that explains it perfectly there as well. That is on our YouTube video. That is on our YouTube channel. So again, you see your selling climax, you see your trading range, you establish your spring, you establish your test, you enter either on the spring or on the test, and then you get out of this accumulation with a massive buy, or also known as the event, right?
So, during the accumulation phase, bro, is there a certain amount of touches you should be looking for before it makes its move, or
No.
like, how do you necessarily, like, how would we possibly necessarily know when the spring is coming before
So
the uptrend or the downtrend?
usually, yeah. So usually, what ends up happening is that point, like that spring, is usually the closest to the 886 fib, right? It's usually the closest to the 886 fib. Does it necessarily always touch the 886? No, right? Not always, but it's the closest one that it will come to the selling climax, or that it will come to, like the bottom of this trading range. So it will usually go under the trading range. Actually, it'll usually like break a little bit below to try to fake people out and try to get them to sell, right? Because what's another retail strategy that we see a lot in like in different groups? Like what do we see? We see, oh, if it breaks out of its range, if it breaks this support, then if it breaks out and it does this, and then we're going to look for a sell. That's very retail, right? That's very retail. Now what ends up happening here? It breaks out of its range, but then it starts buying up, right? You want to get in as soon as, like, say you fib it from here to here and your 886 gets hit, or your 705 gets hit. You get in there and then you buy, right? You get in there and then you buy with enough confirmation, right? So then you'd go to your 15 or your 5 minute and you'd look for rejection, right? There isn't a certain amount of touches. It's not specified. Wyckoff never specified it. By my own experience in the market, you don't specify it either. The only thing that you really look for is you look for that spring, which gets closest to your 885 or your 705 fib, right? And then from there, you end up buying it like this, right? You end up buying it off of that spring. Or if you're not even sure if it's the spring, you get it on the test. If you're a little bit safer of a trader, get it on the test. There's nothing wrong with that. You're not missing the whole move. You're just, missing these little pips that are right here. Now, could that be a little bit later, right? We see a lot of springs sometimes happen a lot later. Sorry, not springs. A lot of tests happen a lot later. Yes, but it's better for you if you're not certain, or if you're a new Wyckoff trader, get in on the test. It's just safer, right? It's just safer for you to get on the test. Even if you call it early, right? Say you think this is the test, you're still in profit, right? If you have if your stops break even, you got stopped out break even, or you took partials, right? Not a big deal. You don't lose, right? You don't lose. And if you think this is the spring, beautiful, get in, right? You got in, boom. You got in, you hit your first take profit, or you missed it by a couple pips, but then you have the test again. You can re-enter there too, boom, and then you caught the buy twice, right? It really all comes down to practice to spot your own springs. Now, the reason why I'm not telling you exactly where the spring is, or exactly where the level you buy is because spoon feeding you isn't going to help you, right? You have to learn to see your own springs. So usually a couple characteristics of a spring that I look at is usually a solid candle or a wick going down there. So a lot of times you will end up seeing something like this, right? You'll see a candle end up going all the way down, right? And then you'll just see it a couple minutes later, you'll see it like this. This is something known as an institutional candle. Reason for that is simply because you look at this and you start saying, hey, this right here was a candle that the markets pushed all the way down to hit their limits. Now their limits could have been right here, right? The markets trade, the banks trade very, very similar to all of us. Right? They also use buy limits, they also use sell limits, they also use whatever the hell you want, right? Now, when they have these limits, the banks push them back to them. They get activated, minimum drawback, and then boom, all the way in the other direction, right? We see this on CHFJPY. Let's go look at that. That is a trade that we took. Let's look at CHFJPY, and this is very, very simple. Let's look at this real quick. Jesus Christ, there's so many fireworks going off. So we see this right here, right? We had our buy zone right here. What ended up happening? We see our institutional candle. Let's look at it on the 4-hour. Right, we saw our institutional candle. Boom, my buy got triggered. 23 pips for 60 pips. Oh, actually, why the hell is my take profit so low? If I would have actually fibbed it, because our entry was up here right on the candle, we would have gotten our entry somewhere. Yeah, so right at our 705, right? Our entry that was called in the channel looked somewhat like this. This was an old markup that wasn't really saved on TradingView. I apologize for that. So you want to put your stop loss either at the 1 or at the 1.1 or somewhere in between them, right? Either way is fine. Now you're risking 21 pips for the possibility, and you use, the last of your fib extensions up here, 144 pips, which actually got hit, right? Your last take profit got hit off of this wick entry. Boom. What was this? Simply accumulation. Accumulation, right? This accumulation ended up giving you a spring, a test, a test. You could have probably, called this a test as well. A spring, a test, a buy, right? A spring, a test, a buy. Now in this situation, your risk to reward ratio would have been massively lowered, right? But it would have still been profit, right? So in this situation, we caught CHFJPY, and this was a perfect example of what I'm talking about, right? Getting your wick entries. So you see that right here. The trading range kind of got stuck out. The trading range got broken, getting closer to its selling climax, right? And then your entry would have been right there. Boom, entry, buy, right? That would have been your entry. So yeah, has this information been helpful to you guys? I hope it
Yes,
has.
sir.
Have you guys understood this?
Yes. Yeah.
Yeah. Awesome, guys. Do you guys have any questions that you guys want to look over specifically?
Me, I'm personally all good, bro.
You're all good? All right. What about everybody else? So, Misha, are you okay? How's your trading been?
I'm good.
That's great. Chewy, how about you?
It's going horrible.
What is that?
Uh, just trying to do stupid shit, sniper entries or low accounts on indices.
Yeah, indices on lower accounts, man. You always want to.
Exactly.
My suggestion is learn to trade very well on high volatility pairs, meaning pairs that are highly manipulated. Euro USD, GBP USD, GBP JPY. For me, GBP JPY is my worst nightmare. I hate trading GBP JPY. It's hard for me. It's like, what the hell, you know? But it's also helpful because, when I was first learning, I hated GBP JPY. Now I see that the key to trading GBP JPY is simply the higher time frames, right? You just wait for that spring to happen, and then you buy, right? And then you're like, oh my goodness, super easy. Why? Because of the fact that you're looking at these schematics and you're saying, hey, same exact thing is happening right here. Now, does this happen on US 30? Yeah, this happens on US 30. What is US 30? The average of stocks, right? And if the average of stocks is happening, what will you end up seeing? The same thing as in normal stocks. And where did Wyckoff derive his theories from? From his years trading in Wall Street, right? So what is Wall Street? New York Stock Exchange, right? Same thing. So at the end of the day, this works perfectly for US 30. But I want you to be trading more GU, more EU, more EG, more of these very highly volatile pairs that will end up making 200, 300 pip moves in a couple hours. That's what I want you to be trading and mastering before you get into US 30. In my
Yeah,
personal
I deleted all of them from my list. Really, this is the last. I learned my lesson.
Yeah, that makes sense, man. What about you, Ivan? You've been good? I hope you've been good.
So I have a question. Would you recommend starting off with a higher account or lower?
I would recommend you go into demo if you're uncertain about a higher account, bro.
See, but there's this thing. I did my demo. I started my demo with 3,000, the lowest you could, and about like 2.5 months, I took it to like 69, doing the same techniques as
69,000 or
yeah,
$69?
69,000,
Okay.
and doing the same like techniques as I do in my live account. But because my account is smaller, I guess I like catch a lot of pullback from too early with my entries, and
Well,
it
the
does
thing is
go the
this.
same way.
The thing is this. If your trading plan is working, the only thing you should be taking, really switching out should be your lot size, right? That's really all that you should be switching,
Mm,
right? That's really all you should be switching is your lot size. Why? Because at the end of the day, your lot size is the only thing that changes, right? So say I had a giant account and I used a 100 lot size. If I used a 100 lot size, I would have to I would have to apply my best risk management and say, hey, my spring, right, whenever I get in, my sniper entry, my strategy shouldn't change from account size to account size,
mm-hmm,
right? So what you can even do is you can even do this. Just put a stupid lot size on US 30, and you're on Eagle, right?
mm-hmm.
Yeah. So I think what's the lowest demo on Eagle? I haven't even opened a demo on Eagle.
I think it's 3,000.
3,000? Okay.
Yeah.
So if you have a demo on Eagle, right? How do you even open it? I couldn't even find like the option to get a demo on Eagle. Guessing it's on their website, but I don't use demos, so. So what ended up happening is you can just put stupid lot sizes on your demo, right? And then
Mm-hmm.
get it down to like 100 or 200 or 300, right? And then just get it down to that size, and then you can kind of trade it that way and then pretend it's your live account and then try to do the
Yeah.
same exact thing just with proper lot sizes. Like there's nothing wrong with using a point oh one, right? A point 0.001. There's really nothing wrong with that. Or 0.01, right? There's
Mm-hmm.
nothing wrong with that. Or 0.02. Those can go a far way, right? There have been days that because I catch a good entry, I've gotten $100, $200 with multiple entries with a point oh 0.01 or a point oh 0.02, right? And well, multiple entries, right? And the simple reason because of that is simply because you end up training your mind to not even think about drawdown. You trust your
Mm-hmm.
stop loss, you trust your analysis. You say you see the spring, you see the test, you enter on the spring or on the test, right? You put your stop loss where you want it, and you will never get stopped out if your analysis is according to the Wyckoff schematic, according to whatever you want it to do. You will end up in profit most of the time.
Mm-hmm.
Now, there is a reason why you have a stop loss, because sometimes news will end up going boom, or if it's a very highly volatile pair, maybe the banks will try to go back down one more time, and your trading range might be extended, or your spring wasn't correct, or you got in too early for the spring, right? Or you were just simply what you were looking at wasn't accumulation or it wasn't distribution, and you got it wrong. It's fine to be wrong. It's okay to be wrong, but the the less times that you're wrong means more money for you, right?
Exactly. Yeah.
So just get on that risk management, man. Start looking at these schematics. We're uploading more modules onto the Discord for Wyckoff, and I want you to be reading those. I want you to be on track with those because you have a good mind and you've been doing well. I've had certain people keep track of all our students and their progress, and you've been doing quite well. I want you to continue, but I
Appreciate
want you
it.
to make sure that your risk management is on point. Deal?
Yeah.
All right.
That's the thing I need to work on. It's more so mindset.
Yeah.
Definitely a thing.
And it's not just positive thinking, right? It's not just saying, "Oh, I manifest this, therefore it will happen." You have to put in work, right? And I understand that trying to make up losses in a day or two is very kind of drastic, but
Yeah.
you will end up getting over that feeling very, very soon. All right.
Okay.
All right, guys. Well, that's gonna be it for today. The turnout was way lower than I expected, but I appreciate everybody that came on. Thank you guys so much for watching, and thank you guys so much for coming on. I appreciate y'all. Much love and take care. Good night, guys.